Hi, Jim. This is Kyle from the Upper Midwest. Thanks for the education you've provided, helping me and others to achieve some financial literacy. I had a question about backdoor Roth and wash sales. For the first time coming up in 2021, I'll have the income level to require the backdoor Roth. I do dollar cost averaging into a Vanguard brokerage account. Instead of taking a total of $12,000 from the bank account to fund the backdoor Roth IRA for myself and for my wife, I was thinking about selling $6,000 worth of the Vanguard 500 Animal shares twice, one for each Roth, in order to bolus fund them. If I sold depreciated shares and then bought the same thing back in a Roth, would I be subject to wash sale even though I've gone from taxable to tax protected? If so, would it make sense to just buy something like a total stock market fund, or would that also fall into the territory of substantially identical? And if I did this maneuver, would this allow me to tax loss harvest, or would that not be possible, given that I'm already moving things to a tax-advantaged account? Thanks again.
Okay, if you sell $6,000 of depreciated shares in taxable and you buy it back in a Roth, would that be a wash sale? Yes, it is. They are very specific that you cannot just sell it in taxable and buy it in your IRA and expect to harvest that loss. Now, is anybody going to know? That's a totally different question, right? Especially if it's not at the same custodian. They're probably not going to know because your Roth IRA custodian does not report what you own in your Roth IRA to the IRS every year, but is specifically prohibited to do that. That is a wash sale. They never really get into your 401k though. And so it's a little bit vague in the rules. Nobody really knows whether you can, sell in taxable and buy in the 401k. In my opinion, it violates the spirit of the law. If you can't do it in an IRA, you shouldn't be able to do it in a 401k. But the jury's still a little bit out on that question. But most of the time, this is not an issue. You can work around this without too much trouble. So, for example, right, just use a different fund in the Roth IRA than you use it in taxable, or just wait 30 days before you buy it. If you need to buy it in your Roth IRA, most of the time you can work around this, no problem. He also talks about using the 500 index. Now, if you're tax loss harvesting and you own the 500 index and taxable, you might as well go to the better fund. The better fund is the total stock market fund. And you can swap from 500 index to total stock market fund. They are substantially different in the eyes of the IRS. So you can tax loss harvest from one to the other. And of course, they're very highly correlated. The correlation between the two is like 0.99. So you basically have the same investment, but not in the eyes of the IRS. It's a different QSIP number, different investment, different index, different stocks. It's fine. I have yet to hear of a reader, listener, blogger, anybody who's really been audited on tax loss harvest issues with the IRS going, those two funds are really similar. It just doesn't happen. It doesn't happen. So unless your brokerage is reporting it as a wash sale, the IRS is probably not going to do anything about it. So let's be honest about what's going on with wash sales there. People just get really worked up about them like it's a big deal. And so what if you get a wash sale? Then the next time you sell those shares, because the market's probably still going down, you're going to recapture that. So these are not that big of a deal. If you screw one up, that's okay. I've screwed up, tax loss harvesting before. It's not the end of the world. You'll get enough losses eventually that you can get that $3,000 off your taxes every year.
If you want your questions answered by the White Coat Investor, record your question at whitecoatinvestor.com/YQA or click the link in the description.